have gotten to work with a celebrity, Ontario-based, to work with an athlete in the NBA.
The largest project that you have worked on has been?
Internally within my firm, about $100 million. In my career, $4.5 billion.
$4.5 billion?
Yeah.
In one project.
So my name is Nahr. I work with Sidhu Investment Group as a debt advisory broker, as well as sometimes equity. I work with real estate developers quite often, as well as with business owners that need debt financing. So what does that mean? I work with private equity. I work with new startups. Kind of get to see the full financial landscape in terms of, the business world, and then property owners. So it's pretty fun.
That's super interesting, right? Because, we've had some conversations before in the past about the stuff that you do, and I think not a lot of people actually understand that difference between like debt and equity when it comes to like actual projects and things like that. So like, what does being a debt broker mean? What does that look like?
Yeah. So, depending on again which type of, asset that we're financing, debt is basically just, you're borrowing from money from somebody. Usually it comes with a packet of rights for whoever's lending. So, for real estate, for example, you'll have a mortgage, you'll have some security over a property, as well as you're entitled to interest payments, but you're not entitled to the upside. So that's kind of the debt side of the equation. In terms of equity, what you're really looking at is you're a partner in the project. You own a piece of whatever you're financing, right? And so you're not entitled to a fixed coupon, but you're entitled to any upside that comes with it. So let's say, you're borrowing $1 million, let's say you're doing a $5 million project, you're borrowing $3 million, you're doing $2 million in yourself. So the debt is going to be kind of the bank, or it's going to be some private lender that's okay with the deal and making a smaller return on that deal. But they get some security out of it, right? If anything goes sideways, they repossess the property. Whereas if you're the equity owner, you're kind of holding the bag. You're the operator. You're responsible for making the return on the project. But if you can, figure out a way to make a lot of money on that, the upside's all yours. All you have to worry about is making your interest payments and your principal payments. And anything on top of that is just gravy for you to take.
Interesting. Okay.
Yeah.
So like, just to try to wrap my head around that a little bit, because I think not everybody necessarily would understand what that sort of looks like. Because you're saying the upside, you don't get a piece of the upside. Yep. So the upside in this case is if the property appreciates, if the property gets more value.
Yeah, that's one piece of the upside.
Okay.
Like, if over time the property's value just increases, that's one of the, markets like Vancouver and Toronto saw that a lot in the last few years. Now they're actually seeing the downside. And so, both debtors and equity providers are both getting hit by that. But so you're kind of, the upside is the appreciation of the property along with any residual cash flow after you've paid your bills. So like, property taxes, insurance, and also your lender, right? But anything on top of that is yours to keep, right? And lenders will want to see that you're making returns, but as long as you're prudent with the finances, you're free to do with that money what you want to do with it, right?
Interesting. I mean, that's a super interesting concept, because when you're on the debt side, the way that I kind of understand it is it's almost like you have a very large limit on a credit card, essentially, in a way.
Effectively, yes. Now there are there's so many different debt type lenders. You can start off at kind of like, most people, they really understand commercial banks just because they're doing their residential mortgages through them and whatnot. But the lending landscape is so much wider than that. So you'll have like tier one lenders, which are like insurance companies and life insurance companies, particularly, but also pension funds that are just looking for assets that are super secure. They don't want to really take on material amounts of risk. Right below them, you'll have kind of your bank type lenders that are looking for stellar deals, but they're a little bit more willing to take on a bit more risk. You'll have your securitizing lenders, kind of similar pools as to those. And then You're going to start looking at kind of the B lenders, which are kind of the, I mean, credit unions kind of fall between A and B, but I would say credit unions would be kind of a B category lender. And then you got this whole landscape where you got private guys and private entities. That whole business model is taking on risk, but
Mm.
pricing it accordingly to
Mm.
the to how much they're taking. So, for example, like a private lender might actually make a coupon of like right now 12% 20%, and
Wow.
but they're taking on risk, right? Like
Yeah.
the deal, they are funding more than the banks are. They
Mm.
are more flexible and giving you more options to do with that money a little bit more. But
Mm.
what they're taking in return for that is that they get a better rate of return, and they may even ask for other assets or outside equity to be involved so that they're also more comfortable in their space. It really just depends on the type of transaction you're doing and the
Mm.
size of risk you're taking,
Mm.
because all lenders, I would say, are very interested in how they're going to exit the project.
Yeah.
And so every lender's, banks and life insurance companies, pension funds, they don't want to foreclose on you. Like
Right.
their objective and their reputational risk of foreclosing on somebody is high,
Right. Right.
and so they don't want to do that. So they don't want to entertain deals, and they still have some deals that come through that will default, but they don't want to entertain deals that will default or are high risk in their perspective.
Right.
And so then we start looking at that second bucket of lenders, which is basically, again, institutionalized private debt. It's expanding so much in our market.
Mm.
Um, and also private guys that have money, private developers that are sitting on large cash reserves that want to get a yield out of it, and they can look at risk differently. So a
Mm.
bank's going to look at a risk and say, you know what, it's you know where we'll be able to sell this property.
Right.
A private lender might not necessarily look at risk the same way. They might say, well, if this deal defaults, I get to buy this property at 60% of what its value is, 65% of what its value is. I'll go build something there.
100%.
And so it's just a different mentality of risk.
Mm.
But it's also like banks don't specialize in building. They don't know what they're doing. So
Right.
they're not
Right.
going to get that same level of risk tolerance for those types of deals. Whereas, if as a builder, if I was a builder, I would be
Mm.
more comfortable, especially if it's in my market and I like the property,
Yeah.
to lend against it because it gives me a yield on what my money is.
Yeah.
If it goes right, which is pretty healthy.
Yeah.
And if it doesn't go right, I can go pick up that project and just complete it myself.
And I mean, from a builder standpoint too, you have so much more control over everything that happens. You have so much more industry specific knowledge too that kind of helps with that. So really, it's a lot less risky for the builder in
Yeah.
that space to be doing that kind of thing.
100%. Like builders are looking at the performa
Mm.
for first and foremost,
Yeah.
and making
Do you want
sure.
to explain what that is a little bit?
Sure, sure. Yeah, I guess not everybody knows what a performa is.
Mm.
So a performa is basically, what does the project financing look like?
Mm.
I'm going to build this. This is what I'm going to sell it for or rent it for. These are going to be the expenses associated with building this project out,
Right.
or owning it.
Okay.
And then, we deduct all that, and this is what my profit margin is going to be. So they can understand that much better than your conventional bank can, because of the fact that they themselves have experience doing it.
Mm.
And they have the trades, the knowledge, and the know-how to do it.
Right.
And so a lot of, private lenders and whatnot usually lend in spaces that they're comfortable and familiar with.
Right.
And so, and again, just to broaden it out more than just real estate, I would say, a trucking private lender would actually usually have some sort of experience in that field, so that they understand it and they're okay with repossessing trucks.
Okay.
And so, it's all based around what you understand
Mm.
and what types of opportunities you see down the line.
Yeah.
And using the trucking example, trucking's been suffering lately because freight prices have been down.
Right.
And there's been a lot of industry consolidation. So there's not a lot of private lenders left in the trucking space, maybe 2 or 3 across Canada,
Wow.
that are actively looking at transactions. But there's opportunity there, right?
Yeah.
Like there's a lot of big players that are consolidating these trucking companies because we were oversupplied.
Right.
And so now these private lenders can actually pool the money together to get some great deals going for seasoned and good operators.
That's super, super interesting because like you're saying, you have these trucking companies where they need lending, either whether it's to expand or something like that. On the flip side, you've got a larger trucking company or someone that was in trucking or something like that that is able to take on a little bit more risk because they really know the true value of what that looks like. They're not just looking at numbers. Exactly. They know what the potential looks like. They know what it's going to look like as you like build this out. And
yeah, well, they're better able to price risk than the banks are, to be honest, because they understand how the operations of these organizations work.
Yeah,
and like private lenders are sophisticated, generally speaking. They understand the market, and so their pricing models reflect the accurate level of risk that they are taking on. Whereas the bank is looking at it more from a portfolio approach. Right. Because they have, all the large banks here have multi-billion-dollar loans, hundreds of billions. A small $5 million deal won't really hit their balance sheet as hard as a $5 million deal will hit a private lender, because pools are smaller, that they're playing with. And so it's much more important for them to get better yield to make up for the fact that there are going to be some deals that they will lose on. Now, private lenders are trying to make sure that they take enough security to make sure that if anything happens, they're still well covered. And some private lenders in our market do look at lending as a lend to own product. But that being said, most private lenders want you to be successful. There's very few that don't. And the ones that don't are usually the ones that are very opportunistic and want to kind of capitalize on an industry that they really understand and are hoping that you don't.
Right. And from that standpoint, it's just a matter of them being able to buy into an opportunity in a creative way where they didn't necessarily have that opportunity before, but now they have the opportunity because you brought it to them.
Exactly.
Yeah. Interesting. So on the real estate side of things, what range of focus do you have? Do you like do the single family side? Do you do the multifamily side? What do you do?
Honestly, it's a lot of things. What I don't do is residential single family like assets.
Why is that?
It's just a different game. And I specialized, my whole career has been specialized in commercial finance, and a lot of it's been in commercial real estate finance. So I understand that market much better. I think it's more lucrative, and also there's an opportunity to scale. Whereas the residential side, I find that there's not as much opportunity to scale. I mean, there's still deals that'll make sense, and there's still some commercial actors in that space, like wholesalers and whatnot. But for me, I just find that I have the knowledge to support commercial growth much more than I do the residential side. And so if there is an opportunity, whether it's coming from my client or from externally from our outside of our organization, I always just pass on those deals to the experts. Just like I'm an expert in my field, I don't want to give somebody advice that I can't back. And so, I got a few people that I just reach out to and send them the deals where I know that I can't do anything here.
That's interesting. So, I mean, by the sounds of it, obviously you've done your best to really niche down into this specific space. I imagine you also have to have very, very specific knowledge to achieve what it is that you're trying to do in that sort of commercial or multifamily as well space.
Yeah, so the commercial space is such a broad term that I'm using, right? So just to narrow in, so there's two major lines that our business does. So one is the commercial real estate space, which includes multifamily, but it also includes industrial, office, and retail spaces. And there's some special use assets as well, like hotels and self-storage, etc. And then that's about 60% of our book. The other 40% of our book is corporate finance, and it's just operating businesses is what we're working with. And so situations where we get engaged there are mergers and acquisitions. A business is experiencing tremendous growth and they can't find a lender that understands that well. Or they're experiencing a downturn and they need to now turn around their business. Usually we'll get involved with the transition state businesses and try and figure out ways to help those businesses grow and access capital. Because many times, strategy meeting capital, meeting good market conditions means that that business can expand so much quicker. And that's kind of where we come in to try and facilitate that growth, or turn it around if they're, if it's a family business and it's been around for a while. There's definitely opportunities. There was one case that I would love to bring up right now.
Yeah.
Where one of our clients picked up a business for $400. This business used to generate a good amount of cash flow, but it got hit during COVID. They had locked themselves into some terrible contracts. And so that business was losing money for the last few years, and the bank wants to foreclose. And so this private equity group wanted to get involved and try to help turn around that business. So they ended up agreeing with the business owner that, hey, we're going to buy your business out for $400.
Wow.
Yeah, it's fantastic, right? So they negotiated with the bank to allow them to take over the business without providing any personal guarantees. Not sure if your audience will be familiar with what personal guarantees are, but basically it basically ties in all your other assets, right? Like, I'm personally liable for this. If I don't do it, we can pull in your house effectively. So it's
take your house, take your car, something like that.
Exactly. It's basically giving them free reign to repossess things for you. Now, lenders don't like using that because, I mean, it's a reputational risk on their end.
Yeah.
But it's something that helps kind of show that you're skinned in the game.
Yeah.
In this case, the group renegotiated with the bank and said, we're not putting up that. So really, $400 was the risk that they took and the sweat equity that they're going to build.
Right.
But what they did do is they went in, they figured out the processes that needed to be changed. They went in and renegotiated contracts. And within a year and a half, they had turned around the business so that it's making $1 million a month.
A month.
A month.
Wow.
Yeah.
And that's in Canada too, where the market's not as big as the States, we'll say, but
so
interesting.
So that's one of the businesses that I got to work with, and it's amazing to see that crux of how they went in and seeing that business now turned around to the point where they don't need bank debt anymore. They were in a shitty spot, but they figured it out. And now this business, I think, is poised for the next level of growth, and they're talking about potentially building out a new factory to help it grow even further, right?
That's amazing.
And they don't need debt.
Yeah.
And so, like, there's opportunities like that where in our market where we can go in and make Canadian businesses more effective.
Yeah.
To be frank, my opinion is Canadian businesses have struggled with competition because we haven't really had a lot of it. And so there's not as much hustle culture. And I know this is going to sound terrible because, I'm kind of, I know how it sounds. But ultimately, I mean, we Canadians, generally speaking, would benefit from more business activity and competition. What I think has happened in the Canadian business landscape is because of government policy, we're not investing in our businesses, which has caused us to be far behind other nations in terms of competition, in terms of technology. And I think now with the current economic climate, we're gonna see a reversal in that trend. And I think Canadians need to start investing in our own businesses, and we need to create opportunities for businesses to grow, because I feel like having a vibrant business environment means wages will go up, right? I mean, if there's more competition for labor wages will go up. It's about creating that opportunity. Canadian businesses, like, look at the airlines. How many do we have? Look at the grocery chains. How many do we have? The banks. And so there is an opportunity to disrupt these industries. But the problem is the legislations that's been in place has reduced that competition to nothing. And so, like, what I'm finding in my space, which is, private debt, private capital, etc., is that there are pools coming together where people want to invest in these alternative investment assets. So in the private capital markets, like, we are seeing competition heat up. And lenders,
Like specifically within Canada, or are we talking about like outside lenders and other people coming in?
I mean, a mix of both.
Yeah.
Like I've talked to multiple capital groups that do want to deploy money.
Hmm.
Now, lenders will chase opportunity,
Right.
right? If I can get a better yield here, I will invest my money here. If
Hmm.
I can get a better yield there, I will invest my money there. There's always going to be the local guys that want to invest their money here,
Right.
just because they understand the market dynamics better. But it just really depends on which like area that you're comfortable in
Hmm.
and whether you understand the market dynamics. Like I wouldn't recommend an Alberta lender to go lend in, I don't know, like Tennessee,
Right.
because you don't know the legal environment, you don't know the um, zoning requirements, etc., etc. So you're just taking on risk without understanding fully what you're getting yourself into. Is that there is a little bit more competition. There's been a lot of people that want to deploy capital, and the banks haven't understood the market space, right? Like the banks are still struggling to figure out CMHC lending.
Right.
Uh, and, that's an area, as you know, is one of the biggest money drivers for me, because there's a lot of opportunity in CMHC. There's a or a housing shortage that we have to make up for.
Yeah.
And so, like, but the banks still are running into issues understanding the program. And what has happened is that the private lenders and the securitizing lenders have really taken a large share of that market.
Right.
Um, and they're better
Yeah.
than the banks, and they're offering better deals.
Really?
Yeah, I
As
mean,
private lenders?
well, because so CMHC business is a securitizable business, right? So
Right.
what that means is that you're able to pool a bunch of these mortgages together, let's say $500 million worth,
Yeah.
and then sell them off as a capital markets product.
Hmm.
Because it's guaranteed by CMHC, effectively CMHC is on the hook for this, which means that the government of Canada is on the hook.
Right.
So rather than you taking on risk from a private, like, financial institution, you're taking on government of Canada risk.
Right.
And what are the odds that the government of Canada won't pay? For capital markets investors in Canada, I mean, it's really not that material. So a lot of risk um, is kind of put onto the government rather than to the investor. So
Hmm.
you're able to get good yields on this kind of stuff from a private lender perspective. It's good to originate that business because you're now holding it on your balance sheet,
Hmm.
but you're catching a spread for originating the transaction. So bringing in the transaction means that you make money on it, regardless of how the transaction goes for the lender perspective. So that's why the privates are involved in the space.
Interesting.
From the investors, like large pension funds and life insurance companies, they want stable assets that pay, right? They will need to make payouts to their insurance claim, let's say, but they need consistent cash flow. And so this is a nice way of them offsetting some of the riskier assets that they're taking on
Hmm.
by saying that this is a government security,
Yeah.
that's going to yield us a coupon,
Right.
right? So it just depends on the motivation. So private lenders have understood that. And so what they've done is they've started originating these, pulling them together and selling them off as a bundled product. Whereas the banks, they like the asset because it's still considered low risk
Right.
in their opinion,
Yeah.
but they don't understand the product super well. And it's taking them time to figure out the CMHC underwriting process, which means that brokers like myself don't love presenting to banks.
Yeah.
Not to say that I won't send deals, and I have my banking relationships and they're great at what they do.
Yeah.
But one of the things that they're starting to learn about is how does this transaction flow?
Yeah.
Where are the pain points for CMHC?
Yeah.
Where are the areas that there is some give?
Yeah.
And because of that learning curve, there's certain lenders that we're just struggling with trying to get them to understand the risk. So for example, I'm not going to name the lender,
Yeah.
but there's a certain lender that said, hey, if you send us a 10 million or under deal, we're going to look at it. And even if CMHC says that they're comfortable insuring 95% loan to value, we're only going to fund 80% during construction. And even though effectively the government's taking the risk on that, they it they won't take the risk themselves because they don't understand the CMHC product is built for
Mm,
that purpose. And I think also
mm,
partially it might be a capacity issue that they don't have the capacity or the skills in that smaller space to be able to take on those deals. So they would rather focus on larger transactions. And this is
mm.
kind of a way for them to weed out deals that are really, needing that CMHC back support.
Well, it's so interesting that you kind of bring up that CMHA backing and support and this kind of thing. And I would imagine, you know, from looking at those deals and understanding that these actual deals are backed by the government in a way, I would imagine that those lenders are able to provide a much lower interest rate because the risk is basically non-existent. Is that kind of how that works?
Yeah. So just to be clear, CMHC, and this is something that I have to talk with borrowers about a lot, is that CMHC isn't necessarily a product for them. It's a product. It's an insurance product for your lender.
Right.
And so basically, the government is backstopping your deal and saying, look, lender, if you don't get paid by the borrower, we will pay you.
Hmm.
And so, yes, the government is effectively taking risk from the lender to themselves.
So why would the government want to get involved in something like that?
Because of the housing shortage. I mean, it helps create supply. It
Hmm.
helps, it creates more opportunity in terms of financing. And so the government's hope is that by, providing a more stable source of financing, that that's one less thing that the developers have to run through. And
Okay.
it's one of the only programs that the federal government can implement across country, right? Because
So
how
CMHE is a countrywide.
their organization,
Yeah.
yes.
Yeah.
And so, like, the government is, yeah, like, so the federal government really doesn't have direct purview over housing, right?
Hmm.
Provincial governments are more responsible for that.
Yeah.
And then the municipal governments also play a role in that in terms of determining zoning law and whatnot.
Yeah.
And so this is a way for them to affect policy across Canada and make it more attractive for builders to get involved.
Mm.
So that's why the shortage is one of the reasons why CMHC is in the business of helping developers get financing.
Mm.
Um, they've been around for I think a lot of people think to COVID and around those times that CMHC's kind of become a big deal in the lending space
Okay.
for developers, but they've been around for decades.
Interesting.
It's just now people are hearing about it because rental housing is become the primary product that a lot of developers are developing.
Right.
Because the rental markets are allowing for access to capital in a way that wasn't available 15 years ago, which is,
Mm.
now new construction deals, you can have 50-year amortizations, you can have 95% leverage,
Mhm.
and you can have those lower interest rates that you alluded to. It depends on how big the deal is for how attractive the deal can be, but
Mhm.
like, just to compare apples to apples, I would say, nowadays a large deal, like in the 30 or $40 million range, you'd be looking at 3.5% to 3.75% through a CMHC insured program,
Wow.
whereas you'd probably be looking at 4.5% to 4.75% for a conventional bank to be involved. So it's a significant cost savings.
100%.
The other piece that you're looking at is conventional lenders are comfortable at 25-year amortizations.
Mm.
CMHC is comfortable for multifamily housing at 50 years.
50 years.
Yes, so it really changes how much you can support as a rental project. And so it's just become a super attractive value prop
Mm.
to be able to finance these programs like through CMHC. Now CMHC is tightening up its rules
Right.
um, because it was to be honest, a little too liberal with some of this stuff. And I say that from the perspective of being in Alberta.
Yeah.
I think the programs are probably very well tailored towards Toronto and Vancouver.
The two like centers of Canada in a way.
Exactly, and the places that were the most unaffordable.
Yeah.
And so Alberta's kind of benefited from the fact that CMHC has to run a national policy.
Has to. They
Well,
have no option to not run a policy in specific provinces and
well,
things like that.
like because there's going to be accusations of favoritism, right?
Right.
Like if I'm making deals more attractive in Vancouver, why is that? If I'm making deals more attractive in Toronto, why is that? Like
Right.
nationally, like you have to even the playing field.
Right.
And so what developers have done is they've benefited from Alberta, Saskatchewan, and Manitoba
Right.
specifically,
Right.
because our markets weren't as unaffordable as those markets were,
Okay.
and because we're running a similar program,
Yeah.
it gives them so much more access to capital
Right.
than what they're used to. And so and that's why you're seeing a housing boom happening in our markets, is because our markets have a lot of room to grow.
Yeah.
And there's a lot of capital to be deployed in these markets. And we, like, if in the real estate space, if you're familiar with it, most REITs are based out of Toronto.
Yeah.
Right. And so there hasn't been, although Alberta is a very industrious province, there hasn't been that much activity in our markets over the 2 decades ago.
Yeah.
I think that's starting to shift, and we're seeing a lot more groups that are willing to invest in Alberta. I'm sure you heard that Vesta Capital Partners are also coming into town, and there's a lot of other developers that are moving into our market because they're like any other investor, they're chasing yield.
Yeah.
And right now, the best places that they're getting yield are in the prairie provinces.
Interesting.
Yeah, because our incomes are high across the board, and our rents were relatively reasonable. Costs to build weren't terrible. We don't have terrible programs that add $100,000, $150,000 to developments just for government surcharges.
Yeah.
Right. And
Yeah.
so you're seeing people benefit from these programs because our provinces have been more traditionally business focused. And so that, along with the CMHC adding fire to the fuel, fuel to the fire, like our markets are ready to and continuing to explode.
Yeah.
And so there's a lot of opportunity. Now, what I do see coming up is that we are supplying a lot, and immigration numbers have come down.
Right.
And so we're not seeing as much people move to our province, although
Right.
we are still seeing positive net migration. And I think that trend will continue as Alberta is expected to fare better than the other provinces in terms of these Trump tariffs.
Yeah.
So as we see more people move from the provinces, that's going to offset some of the supply that we're bringing on. But we still continue to struggle to maintain infrastructure in terms of how many people have moved into our city. But the catch is now we're also starting to, Alberta's development industry has been very willing and able to supply housing when needed.
Right.
And so we've been able to turn around and kind of effectively go and build, whereas other municipalities across country have not done that same level of incentivization for developers.
Yeah.
And so we are seeing a lot of supply coming, which may cause rents to either flatten. My expectation is that they'll come down slightly. Not to say like I don't want to worry the market and say, okay, you know what, you're expecting rents to come down. There's a few other factors that'll play into that. You'll probably also see, because of the interest yields, you've already kind of seen some upside being added to the market from an interest rate perspective.
Right.
You'll probably see a little bit of that continue on. Now, and it's anybody's guess where interest rates will end up, but the Bank of Canada is facing a really interesting decision as well, right? So, but there's been enough interest rate decreases that projects are still very viable in our market, and frankly very lucrative. And so I think builders, like from an economics theoretical perspective, because I like looking at both perspectives, the practical and the theoretical. You're gonna have builders build up until the point that there's no profit in it.
Right.
Right. You're gonna have builders just continually supply the market if there's money to be made.
Right. Yeah.
And once there's not money to be made, then we'll start seeing people taper off, and that's kind of what happened with Vancouver and Toronto. Is that there's a lot of money to be made, and then there wasn't.
Yeah.
And so that's kind of the tale that would be followed.
Yeah.
The only thing is that we still have some good tailwinds backing us. Oil and gas is under our feet,
Hmm.
and so that's always going to be the case. It's not like Detroit where the auto industry can move.
Yeah.
Um, we are a resource-rich province, generally speaking. I mean, we got lumber in the mountains and and mining as well.
Yeah.
And so we got the agriculture industry as well. That's very strong
Yeah.
in our province. So I think there's a lot of positives being in Alberta and in the prairies, where there's a lot of resources that we still have an opportunity to exploit. So that I think, the next few years, depending on how these tariffs play out, might be rough, but
Mm.
we're really poised well for growth.
Mm. So interesting, like what you're mentioning about, Alberta being a very resource rich kind of province. It's an interesting thing looking at Vancouver as well, because the way that it's laid out there, you have a lot of these really small homes that have been turned into duplexes, whatever, the top down and then the bottom,
Yep.
that kind of are rentals that way. And because of that, finding land to actually build on in Vancouver is so competitive. And as a result, the cost to build and the actual profit that can be made, I mean, that's kind of really where that gap sort of comes. But here in Calgary, we have so much land available to us. And then on top of that, too, because of the way that, the environment is here as well, it's a bit of an interesting one as well, because, Vancouver, again, rents don't really fluctuate that much. For the most part, it's just a pretty steep climb, right?
Yeah.
Whereas,
I can actually speak to that. So
please.
when I was a CMHC analyst, I was looking at a file in Vancouver,
Mhm.
and at that time it was 2019ish, I would like to say. Um, I remember looking at Vancouver as a market, and they had 1 year in the last 36 years where rents went down $5. $5.
$5.
That's it,
Whew.
and the rest of it was a upper hill climb.
Wow.
What you are talking about, yes, Vancouver's landlocked. There's not a lot of opportunity to expand outwards.
Yeah.
That being said, for a municipality to grow, there's a lot of considerations. One of which is you don't want the urban sprawl to be so big that your infrastructure costs just go through the roof. And
Right.
so that's why you're seeing, cities like Calgary and Edmonton densify, is that we've spread out quite far.
Mm.
And so,
Well, is Calgary? I mean, I remember seeing something about Calgary as a city being the largest geographical city in the world.
it is one of the largest, yes.
Yeah.
And so it's not sustainable for our infrastructure. Because now, like, if we continue to build single family homes, we are going to face infrastructure challenges. We're going to have to get the power lines there. We're going to have to get plumbing. We're going to have to get gas lines there. We're going to have to build roadways.
Right.
All of that has to be spread out through a tax base.
Yeah.
And the more spread out your tax base is, the more you're going to have to charge them, because now there's more infrastructure that needs to be maintained
Right.
and built.
Yeah.
And so that's one of the reasons why densification in our markets is necessary, is because we need to spread out these costs among more people.
Right.
And so that's, I see this, like, Canadian markets in general, and I would say the major markets, Toronto, Vancouver, Edmonton, Calgary, Winnipeg, but like are the major ones, are going to need to adjust to kind of more European living style, which is you're gonna have more density, you're gonna have more community spaces within that density. Where I think there's opportunity, especially for developers in Calgary, is actually not just supplying the housing, but starting to supply the retail, the amenities spaces, because there's a lot of developers that can build housing. There's a lot less that are trying to do retail development. And I know, there's big headlines with the Hudson's Bay now going under, and other companies that are facing pressure from the tariffs, but also from a lack of consumer confidence in the markets generally. We're gonna see, that happen. That being said, there's still a need for community retail. Like, I still want to visit a community barber, for example, or a community doctor, a community dental clinic. Like there are still need for community services. I don't want to drive across town to go visit my doctor, right? Like I want to be able to drive to his office within 5 minutes of my home
Mm.
because that's convenient. But
Mm.
also as we densify, I mean, the traffic's going to get worse. That's an expectation.
Yeah.
Um, the the ability to move across the city is just not as viable as it used to be. And so I think we need to figure out ways where we can now stay more locally. Like I know I know that there's been some negative press and feedback around the 15-minute city. But effectively you do want to have resources nearby. Like I personally don't want to drive across town to go and have to go to a service that I need once a month,
Mm.
right? Like whether that's, going to the doctor, whether that's going to a convenience store, like I want those so close that we have access to it. And so I think what Calgarians need, and I think probably similar in Edmonton, is that we need more retail development to to fill in the gaps that are being left in the market, because at some point we're going to have a lot of density and we're not going to have enough of these places. And so now you're going to start seeing traffic build in areas that shouldn't have traffic, but also, there's got to be more vibrancy in our markets anyways. Like I
Mm.
said earlier, like I think we need more competition.
Mm.
And I think the best way to do that is to, you know, have access to spaces and to actually just be more entrepreneurial as a culture.
Mm.
But what our culture has done to the entrepreneur has not been good in the last 2 decades.
Mm.
Like we do not have the level of competition that we need to
Mm.
compete globally.
Mm.
I mean, from a broker perspective and from an entrepreneurship perspective for myself, it's fantastic. It's easy
Mm.
to go out and hustle
Mm.
relative to what I'm seeing in my market.
Mm.
But I think generally speaking, for the betterment of Canada, we need more competition.
Yeah. Well, it's so interesting that you're kind of coming back to this whole competition thing, and one thing that we're, I think, very fortunate about coming back to this again is we have a lot of land here, and so as a result, kind of the trajectory that we're going is with the growth of AI and all these data centers and all this kind of stuff, we have a real big opportunity where we actually have people here in Calgary that I've spoken to that are working and planning to build out these data centers here in Calgary, not necessarily in Calgary, but in Alberta, more in the north, because of, number one, we have the land available, the land's cheap, and two, when you look at a data center and you understand like how much heat this thing is generating and how much it actually takes to cool this thing down, because of just our natural environment here in Alberta, it's a little bit cooler, which means naturally you're able to save energy, which naturally means that our electricity is able to actually generate a lot more income as a result, because you're saving based on the environmental effect that we have here, right? So
100%.
like just talking about like the industries that we have already, there's more that are kind of building, and again that comes down to that land that we have, right?
100%. I think we've been really blessed to be born into a nation like this. There is a lot of land, but we've been blessed with a lot of resources as well. And I think the top three resources are going to be like we have access to it in our soil, which is energy. I think that's going to be driving global trends just because of, everything's electrified now. Everything's like we need energy. Like there's just no getting around energy.
Mm-hmm.
Now, how we produce that might change over time. We might be moving towards more sustainable sources, but at this point in time, oil and gas is still the most viable product.
Mm-hmm.
And so I think that's a great starting point for us to build our nation off of. And then we got all these other resources that we can take advantage of. We got water. We got, like we got rare earths. So one thing that I think Canada and Canadians have been poor at doing is exploiting what we've been given.
Right.
And I don't mean exploiting in a bad way. I mean exploiting as in we have the opportunity. We can develop it ethically. Why not develop it? We have some control here, because the market demand for these resources is going to be the market demand, regardless of what 42 million Canadians do. The 8 billion um, other nationalities will still have their own demands and their own pulls. And so I think that if we can supply the market, we can do it in an ethical fashion,
Yeah.
whereas others may not necessarily be viewing it the same way.
Right.
So I think like Canada and Canadians need to really start focusing in on what we can supply to the world. And I think one thing that we really made a mistake on was trying to compete in the manufacturing sector. And I'm not like no ill intent towards the manufacturing center, like manufacturing sector, but by us so heavily focusing on that, that was the 19th century. That was the 20th century. We are now in the 21st century, and manufacturing is gonna become more and more focused on robotics, more and more focused on technology and capital, than it is going to be on the individual. And so we've been trying to preserve these types of manufacturing jobs and trying to say that we're not going to harm the environment or we're going to limit our growth in those areas. But really what's going to end up happening because of that is we haven't been competing. And in fact, we can't compete on a labor market. Our populations are not large enough. Our wages are too high relative to global wages. And so unless you want to compete with large population centers that don't pay well, we're not going to compete. Like we tried to compete in a market where, you have countries that are violating basic rights in terms of, manufacturing, like where there is child labor, where there is, effectively not a living wage. And so for us to compete, the only way we can compete is by reducing cost. And that's one of the reasons why we have this affordability crisis, is because we've been competing in the wrong market. What we should be competing on is innovation. And yes, there is opportunity for us to still compete in manufacturing. I'm not saying that manufacturing is a losing game, but we got to deploy capital and resources in the way that we need to make sure that like it compensates for our higher wages. So for example, if a widget can be manufactured in a different country, in a factory with one worker for 10 widgets an hour, and we do the same, we're not competitive because our wages are higher.
Yeah.
But if we can get technology in that factory and now have that worker complete 100 widgets in that same hour through a single worker, now we're competitive, right?
Yeah.
Now we've just cut our wages by 10x because now that employee is doing 10 times the work. And so that's kind of where we've screwed up, is that we haven't invested in our businesses enough to allow for that technology to occur. And so I think Canada needs to start reshifting itself into a global power through innovation, through research, through knowledge-based industries. Like we should be a global leader in energy. We should be a global leader in technology. But we need to create the environment and the spaces that allow for those programs to really thrive. Yeah. And we haven't done a good job of promoting the entrepreneur,
Right.
Which is truly the backbone of market economies.
That's, yeah, no, well said for sure. So I kind of want to come back a little bit. When we were talking about, all of the land and the development and this kind of stuff, you're talking about how we need to look to try and kind of push the city all together, kind of develop a lot closer to those centers, just because then again, from an infrastructure perspective, it's a lot easier for us to deploy capital a lot more effectively, essentially. So coming back to that, one thing that I've heard a lot of recently has been this one CMHC program called MLI Select.
Yep.
And with that one, again, what that intention that the government has in that program I mean, it kind of sounds like, is to really do that, where you're kind of bringing everything together. You're able to build these multifamily projects instead of these single family projects, and really kind of take the risk out of those projects and the building, so that we can scale a lot quicker. Can you do a little bit of a breakdown of like what that program kind of looks like and what the benefits would be to something like that?
Yeah, so the big benefit for the MLI Select program is the leverage. You can get 95%. The other benefit is that you're looking at a debt service coverage ratio of 1.1. I know a lot of your viewers won't know what that exactly means, but so I'll walk through that. So effectively, when we're looking at a loan, there's three ways that we cap the loan. One is it's got to be under 95% of the build cost. Two is that it's got to be under 95% of the value of that building, because sometimes those two things don't align. And so it'll be the lesser of those two things. And then three is that it will be the lesser of what the debt service coverage ratio of 1.1 allows for. Just kind of basic math, let's say you're making $1 million from your property a year in terms of gross rents. So for simplicity, I'm going to just use the townhome example. So let's say your townhomes are generating $1 million in cash. You're going to be looking at, typically in our market, about 25% of that's going to property taxes, insurance, utilities, as well as repairs and maintenance, operating expenses, et cetera, et cetera. Mm-hmm. So once you take off that 25%, you're left with $750,000 that you're going to be grossing if there was no debt. Now, when you layer on that debt, what CMHC and what lenders want to see is that, that 750 divided by 1.1, which will be something like, what's kind of 9% of that is taken off. So let's say, just for simplicity, let's say 10. So that'll leave you with $675,000 to service your debt. Now, wow, that is what you're going to be able, like, that's where the lender is going to be comfortable with your payments being. So they're going to reverse engineer the loan amount to be a maximum of, and your maximum annual payment can only be $650,000 or $675,000.
Right.
And so that's kind of how they work that program.
Yeah.
So those are the three caps. And what we're seeing in our market is that we're seeing that debt service coverage is the big restriction that's stopping you from getting as much access as you can. Now, sometimes it'll be build cost, sometimes it will be value, but generally speaking, I'd say 50% of the files I see that debt service coverage is the restriction, not value, or not cost. So that's kind of how they cap your loan. Versus the CMHC standard program, they allow for a 1.3 debt service coverage ratio. So instead of that 750 being divided by 1.1, it's divided by 1.3, which means that there's less cash in your pocket. And so because of that, you're now able to qualify for less. So that's where the CMHC Select program comes in, is they're providing you more bang for your buck. What they're taking in return is also significant, because most people will talk about all the benefits and not the commitments that you have to make in the program. So one is that for new construction, 25% of your units have to be affordable. Fortunately for us, that's in Calgary, in Alberta, that is $1,735 in Calgary and $1,665 in Edmonton.
Wow.
So they're still pretty substantial. But that's kind of at least 25% of your units have to be below that number.
So only 25%
for new construction.
New construction.
Yeah. For existing construction, it's 80%.
80%.
Yeah. Yeah.
Wow.
So anything that's an older product that's more than 2 years old, 80% of your units have to qualify under that for it to qualify under the program. Effectively, it eliminates most newer buildings. Now, older buildings can still take advantage of that program because their rents are usually generally lower, and effectively it's removing a lot of townhomes from the program from that. But yeah, so that's kind of the benefits of the Select program. But what you're committing is also not just do those rents have to stay 25% of your units have to stay below those numbers, you have to commit to keeping them affordable for 10 years. And so they'll only allow you to raise rents by their index for the CPI. So, it limits your ability to raise rents on those units. So that's kind of what you're giving up to get part of that program. The catch is that it still ends up being much better off for you than you doing the standard program. And so we're seeing a lot more volume on the select just because people want to take advantage of the program and maximize their ability to pull out funds
and have less interest on their loan as well. That's a big one, right?
Yeah, I mean, interest rates can fluctuate. Some lenders care about you being in that program, others don't. So that can fluctuate. It's not necessarily that you'll get better interest rates, but what you will benefit from is that lower debt service coverage ratio. So it qualifies for you for more, so that you have less equity in, and so yield on your cash will be higher.
Oh, okay, interesting.
Yep.
You've been in the lending space for about 10 years.
Yep.
And in CMHC for about a year and a half, which means that you have very, very specific knowledge that a lot of other lenders wouldn't typically have, which means you kind of have a competitive advantage over a lot of people. So with that in mind, has that resulted in you having access to like bigger clients that you wouldn't necessarily have access to? Like, have you ever worked with any celebrities or anything like that?
Yeah, I mean, fortunately for us, we have gotten to work with a celebrity. I mean, I won't name any names, Ontario-based, but it's been pretty cool. And then
Ontario-based.
It's funny because we see a lot of, interesting files, right? And not always are they celebrities, but we've gotten to also work with an athlete in the NBA, right?
Wow.
So and I'm not going to say that one was a client of mine. It was a client of our firm's, but it's just cool to be able to kind of see different things and different perspectives. And, in the last few weeks, I've had the opportunity presented to me where somebody wants to introduce me to a local billionaire. So it's just like,
just
wow.
Another local billionaire.
Yeah. And then I'm also working on trying to get in front of one of the wealthiest families in Alberta. To see what their appetite is, because what I'm finding is that there's really two areas, and I don't find a lot of competition in the real estate space, because my vision is to try and become more of a comprehensive investment bank type organization for real estate. And so the real estate market's been fairly rigid in terms of how people look at deals. Because the deal flow has been pretty consistent in the last few years, lenders are just not creative anymore.
Right.
And so what my objective is to find creative solutions and creative lenders for those solutions. So for me, I actually got the opportunity to be a part of a private equity deal that I put together with a group that had a great project. Unfortunately, didn't have proper accounting advice, and so their budget was a little bit off, and so they needed to raise equity at the last hour, which is you're mid-construction, you're kind of stuck if you can't find the equity to move into the next step. And so we found some equity for them, and one of the conditions that we had placed on us was the lender wouldn't allow us to charge the property with a second mortgage.
Right.
They feel that it presents too much risk. My opinion on that is just, no, it doesn't. Because they can technically blow us off the title. So what that means is if there's an event of default, they can just say, look, you know what, we're in first position. It doesn't matter what happens to you. We're going to do what we're going to do unless you pay us out. That's the only catch, is that they would, if we had an opportunity, we could potentially buy out the loan.
Wow.
But for us to do that, it would be very rare circumstances where they're defaulting, and at that stage where we wouldn't have already kicked in more equity to try and save the deal, because we also want to protect our capital. So the lender said, no, we can't do that. And so we found that we were going to do a convertible debenture. I'm not sure if you're familiar with that investment product. Most people won't be. But it's effectively, we're lending to the company rather than the project itself. So instead of taking security against the asset, we're
Hmm.
taking security against the company. So if anything
Wow.
happens to the company,
Right.
we like we can recuperate whatever gets left into the company.
And then because of that, it kind of de-risks it to the lender, because then you're not going directly against
Their
that
property.
asset, you're going against the company, which interesting.
Yeah.
Yeah.
So it is different. It's a different way of looking at things. And so we were able to securitize against, yeah, that and some outside assets. And we feel comfortable with that because I understand the CMHC program fairly well. And so we know we're going to get refinanced out. There's as long as there's a property there, and I've physically visited it, so
Hmm.
I know that there is. Um, and as long as the rent up is what we expect it to be, which again, there's a few other buildings in that area where we've been able to canvass the market and see what they're renting for.
Yeah.
Um, so we should be fairly confident in our ability to take out that loan through a CMHC loan.
Hmm.
So we're not too worried about that piece.
Yeah.
But because there's a lack of understanding from the lender perspective as to um, private equity and private investment vehicles like this, they just don't want to entertain it because they have too much volume
Yeah.
and they don't have the knowledge base to be able to pull concepts from corporate finance into real
Hmm.
estate finance.
Hmm.
And so what I'm learning and what I'm seeing in the market is that there's a gap in real estate knowledge
Hmm.
in the commercial space, and there's a lack of commercial knowledge in the
Hmm.
real estate space because we've siloed these industries for so long. And
Hmm.
fortunately for me in my career, I've gotten the opportunity to work in both sides of the transaction.
Yeah.
I've done private equity deals, I've done um, operating company deals, I've done real estate deals.
Hmm.
Fortunately, I've worked at CMHC, so I know the products that we're working with,
Hmm.
and I know the level of risk.
Interesting. So kind of what you're saying and the way that I'm hearing what you're talking about, it kind of sounds like in that like lower market, you've kind of got a gap where the big lenders, they have too much money to deploy and it's not really worth their time to put that effort into, deploying capital into these smaller deals.
Well, so there's a huge market gap, right? Um, and it's because there's not really any proper investment banks focused on real estate. Um,
None.
Not, like there are a few um, debt and equity brokers like myself that are kind of playing in both,
Yeah.
but most debt and equity brokers, especially in the real estate space, only understand the two concepts of
Right.
debt versus equity, first mortgage, second mortgage, and that's kind of the conventional security package that you'll take
Yeah.
from a debt perspective, and then they understand equity, and they don't really understand kind of the middle product,
Hmm.
because there is a middle product for this, and that is it could be called this, like I said, convertible debentures, preferred shares, can also be used as investment vehicles to get exposure
Hmm.
and take on some equity style risk
Hmm.
with some debt features as well,
Yeah.
right? So what I'm finding is that the investment banks like RBC and the big banks, they're focused on REITs and large players like multi-billion-dollar companies.
Right.
And so they're not really coming into the space where the middle market is,
Hmm.
um, at least in Alberta. And I can't speak to all the markets in this because I'm still exploring um, Alberta's own landscape before getting into the other parts.
Yeah.
But so in Alberta, that's what I'm finding is that there's not really any investment bank that's focused solely on real estate.
Wow.
And so there's
That's so
not,
surprising with such a large housing crisis that we have.
yeah,
You've got no one that's entered into the market to try and deal with that.
yeah, because like the thing is like debt and equity brokers, like I'm competing against some of these folks as well, and I'm a debt and equity broker as well, right? So like the catch is that you're also competing with us, and then there's other products and all this other stuff, and there hasn't been necessarily a need up until now.
Right.
Uh, but I think that as you know, the markets get more vibrant, and we are going to need products like this
Hmm.
to come into the market so that we can supplement growth. And it's taking smart risk, right? Like it's figuring out ways where you win either way
Hmm.
for some of these lenders. Um, and yeah, so like I think there's an opportunity here for people to create different financing structures that'll give you access to capital.
Hmm.
Like, and you don't necessarily need to be an equity partner to that because a lot of developers don't want to give up their upside,
Right.
right? But they might have short-term bridge financing needs
Hmm.
that they like. For example, that deal I was talking about earlier, where their lender won't let them get a second, and and private debt doesn't understand structuring around that because they have so much other deal flow.
Yeah, they just don't recognize you could just.
Yeah, they don't want to spend the effort of learning it even,
Yeah.
right? Like
Yeah.
they don't want to overcomplicate their lives, and that's fine.
Yeah.
But it creates an opportunity for private placements into debt that you know give you a very healthy yield, and you carry some risk, but you can mitigate around that as well. Um,
Are you able to share like where that deal is located and like how much investment was required to kind of help bridge this gap?
I would prefer not to,
Okay.
so but I can say that there's been a few opportunities like this that have come across my desk in recent times, and I'm actually trying to explore and see if there is a market for that. I've met a few people that have said that they are also looking at providing some sort of real estate debt solutions
Okay.
for that type of product. If as long as the yield is there,
Yeah.
that understand corporate finance better than most, right? So there's an opportunity there, and I think that as our markets develop, there will be more people coming into the private debt market.
Hmm.
Our private debt markets haven't been traditionally very full, and in fact, what we're struggling with is finding lenders more so than we are finding borrowers. Right?
Hmm.
Borrowers, when you need capital, you'll approach any capital source you can find.
Yeah.
Um, within reason, right? Like if your deal is bankable, you're not going to go to a private lender,
Hmm.
um, or at least I would hope you wouldn't go to a private lender. Um, yeah, so like, but what's happening is that these private lenders are still filling up their boots with everything that they can find, and so they're being very selective too.
Hmm.
And sometimes it feels like these private lenders are starting to become more bank-like in
Hmm.
that they're seeing so much volume that they're being picky and choosy about the transactions that they're funding.
Hmm.
Because of course, from a private lender perspective, why would you take risk if you don't need to, if you can get the same yield elsewhere?
Yeah.
And so, some of these private lenders are now being inundated with deals, and so they're being very selective about the deals that they'll take on.
Okay.
And yeah, so it's creating some interesting market dynamics and gaps again
Hmm.
in our market. So I think there's an opportunity for privates to get involved and take risk.
One thing that I think was a little bit surprising to me as well, just being here in Calgary, was because I wasn't too familiar with the debt space before I did come to Calgary.
Yeah.
And then with all these events that I'm going to and talking with all of these private equity guys, not necessarily private equity guys, but venture capital kind of guys, a
Yeah.
lot of their funds are based in that debt space, which is super interesting. And also too here in Calgary as well, like comparing Canada in the lending space to the States, like the amount of people that I've talked to that have said, oh yeah, this person could not get funding, even though they were showing cash flow here in Canada. Then they went down to Seattle and they got $2 million.
Yeah, well, you know
You
what's
know,
really
or
sad to me
yeah,
is that like one of the co-founders of Uber was a Calgarian, right?
right, really, yeah,
And so like for us not to be even able to retain that type of talent
yeah,
is telling in terms of how competitive our capital space is,
yeah,
right? There, like I said, there's gaps everywhere in every market that we're finding, or at least that I'm being exposed to. There is opportunity
yeah,
as long as you're willing to seize it.
yeah,
And so, yeah, like I think there's like capital is one thing,
yeah,
but we've just not done a good job of supporting our entrepreneurs.
right,
And I think that's got to start changing for us to be competitive globally because we are going to need people to innovate and we are going to need more competition. In my opinion, I mean, it was like as much as I don't love talking about the government, um, like
That's a
like
loaded thing to
politics,
say.
politics,
Yeah.
right? Like everybody has their own politics.
Yeah.
But one thing that I think that we should not have done is approve some of these mergers.
Right.
Like we should not have allowed Shaw and Rogers to merge. I mean, who does that benefit? Who does less companies and less options benefit? Is it Canadians? I don't think having less options is the way that we're going to compete. Um, and so, like, we've seen that in the banking space. We've seen that in the oil and gas space. In fact, in the oil and gas space, I can kind of speak to this a little bit more, is, small and mid-sized oil and gas producers aren't able to find financing. The banks won't finance them because, unfortunately, the banks have ESG targets. And so they've deployed X amount of capital, and they're not looking to grow that capital in the energy sector anymore.
So essentially the banks have gotten to a point where they're just like, yeah, you have too much capital in this industry. You're not allowed to go ahead and try to finance these.
There's a few risks that banks face, and it's a hard decision to make for banking.
Yeah.
Because oil and gas is stigmatized.
Yeah.
And so, they RBC bought a bank. I think I can't remember what the bank's name was, but I believe it was in California. And so they got protested for financing pipelines. And so they lost a whole bunch of business on that. And so what does the banking sector do? They look at reputational risk.
Yeah.
And unfortunately, oil and gas is viewed as a reputational risk now. And I don't necessarily agree with that, but it is how the general populace is viewing it in certain markets. And so banks don't, even though there's profit to be made, banks don't want to deploy more capital because they feel like they'll lose out on other business.
The whole eggs in one basket kind of situation.
Well, not just that, but also, like, if I don't support your views, I might not bring my dollars to your bank.
Oh.
Yeah.
Oh, wow. So like a very high level politicking
yes.
kind of thing.
So like they are being lobbied to not be in those industries. And so as a result of that, what you're seeing is that banks, like, to the bank's credit, they haven't reduced how much money they put in the sector. But what they're finding is that they're just being more selective in moving up market.
Okay.
If you're familiar with the term, up market effectively means that you want to deal with larger clients.
Right.
And so some of these smaller clients, when you only have, let's say, 100 billion, and I know that's a big number,
yeah.
But if you only have a basket of 100 billion, you're not gonna give 100 million to 10, 15, 20, 100 companies or whatever the number works out to be. You're gonna try and deploy it to the larger players that are stable, that have been around, the Suncors of the world, the CNRLs of the world.
Yeah.
And so when their capital needs grow, the banks will allocate some capital from some of the other accounts that they're looking at. And not necessarily is that they're taking that capital away, but through M&A activities and whatnot, there is some capital that comes back to the banks that gets redeployed, and it's getting redeployed into bigger companies. And so these smaller producers are having to go into the private lending space again. And because of that, your bank debt's going to be at like 8% or 9%. Whereas your private debt is going to be at that 12, 14% range. Right. And so competitively, you're losing 3% margin just through the financing exercise.
Right.
And so like your small producers are really struggling. And so even though there's not really the government's done a terrible job of supporting this space as well, but you're not really, like, from a financial perspective, you're not able to support those businesses as well. Yeah. Like, so many banks won't support an oil and gas company that's producing less than 10,000 barrels per day.
Less than 10,000 barrels per day.
Yeah.
Wow.
So, what does that work out to be over 365 days? This is millions of barrels.
Yeah.
And so, you're seeing that play out. And so there's not as much competition in the oil and gas space as we could have. And it's not necessarily all the fault of government.
Yeah.
Um, it's also that we can't finance them. And so, again, because of that, we're just not having the level of competition that we need for wages to go up. I'm not saying that I want these big giants to be super uber profit taking entities and where everybody else's money is kind of stripped out into these entities.
Yeah.
But I think creating more competition results in employers willing to pay higher wages.
Right.
And because they're going to pay higher wages, you're going to have a more vibrant and more affordable society in general. And what we've done is we've kind of gone out and we've created so little competition or created so many barriers to competition
Yeah.
that like we've really handed over control of total industry to a few major players in each industry.
Right. So it's not quite at that monopoly stage.
We're kind of like, I mean, I wouldn't say that Canada's an oligopoly either, but we're headed there.
Yeah.
And I think we need to start reversing that trend for us to, again, compete globally. If we have good competition internally, that competition will play out globally. Like if we can compete within Canada, we will be able to compete outside of Canada. But the problem is that we don't have the incentive set up. And you know, one of my favorite investors, Warren Buffett, says this all the time.
Isn't that one of almost everybody's favorite investors?
Yeah, well, he's a great value investor, right?
Yeah.
But one thing that I love, one of the quotes, and I think I've probably even spoken to you about this, is it's show me the incentives and I'll show you the company, right? If you incentivize management right, if you incentivize entrepreneurs correctly, I mean, we can apply that across the board. If incentives are set up right, people will behave based on those incentives.
Right.
And so I think we need to reshift some of that mindset of, hey, we are a collaborative society. We collaborate in a lot of fields. I think there's certain areas where the government has to step in to make sure that industry is doing well, right? Like, you know, education might be one, healthcare might be another.
Right.
But we also need to figure out ways to make sure that our free markets stay free. So, but what we're looking at is cooperation has led to less competition.
Yeah.
But also we've regulated ourselves out of competition as well.
Right.
And so I think societally, we need to kind of look internally and see where we want to go as a society. And my opinion, again, just one guy, is that we got to turn around and say, look, you know, we're competing. Like, you know, if we don't do it, somebody else it will. And I think if we're going to just put ourselves in a bad spot if we don't.
Yeah.
And so I think we need to really shift our priorities to, again, incentivize business, incentivize developers to kind of do what they're doing, but make sure that everybody kind of knows that, you know, that's the target, that's the goal, because that's going to, in my opinion, that's going to lead to the best outcomes for us. I know, like, you know, there's a lot of people that'll say, okay, you know what, we can have socialist programs, or we can have, you know, more community-focused programs like communism.
Let's not suggest that, but
Just to be clear, not suggesting that. But I think there's a lot of focus on trying to, you know, make sure everybody's doing well. I think one of the catches is as humans, we're also incentivized to look out for ourselves. And yes, even though, you know, everybody wants to take care of the community in general, the best way to do that is to build, to actually innovate, to compete with each other, to be better. Right. And I think we've struggled with that piece. It's like we can be better. We need to make sure that we're incentivized to be better too.
Yeah, we're really not taking the efforts that are necessary to try and promote that level of growth. You know, that mindset here in Canada. I mean, it's unfortunate, but it's the reality. Is you start a company. If you do start it here, you take it to the States or sell it in the States, or that's your exit plan is the States, right? And that's not always the case, but when you've got a company and you're looking to grow it to a larger, you know, scale, we're very limited in what our options are here.
100%. I mean, and to be fair, I mean, the States has such a larger population base than we do. It's economic for us to take it there.
Yeah.
That being said, I mean, we can still house this. Like, the thing that people forget is capital is important.
Yeah.
And so if we go and move this company's base of operations from Canada
Yeah.
to the States, where does those dollars go?
Yeah.
Do they come back to Canada or do they stay in the States?
Yeah.
Right? We can still have Canadian-based companies doing business in America.
Yeah.
Bringing back American dollars for us.
Absolutely.
Right? And that will flow through our economy. But
Yeah.
what we've created the incentive to do is instead is move our Canadian businesses
Yeah.
and relocate them in the States. And that's keeping capital in the States, not in necessarily in our markets.
Right.
So what we've done is we've stripped out talent. We've stripped out capital from our market for far too long.
Yeah.
And we're putting ourselves, again, in a position where companies like Uber
Yeah.
aren't able to thrive in our markets because we don't have the capital.
Yeah.
We don't have the government supports.
Yeah.
We don't have enough to offer entrepreneurs
Right.
relative to the globe. And so
Yeah.
we're not innovating as we should, and we're not retaining that innovation as we should.
Yeah.
Because it doesn't matter if you're a Canadian, like if you want to do business in the States, it doesn't matter.
Yeah.
Like go do business in the States. But if you can bring those dollars back to Canada
Yeah.
and deploy that money in Canada as well, you'll develop Canada.
Yeah.
What ends up happening inevitably is because of tax policy, because of access to capital.
Yeah.
It's just easier doing business in the States.
Yeah.
And because it's easier, people will move there.
Yeah.
And they'll relocate their offices there.
Yeah.
And so you'll end up holding on to that capital because capital cycles through your economy.
Yeah.
And so what ends up happening in our market is that we don't retain it.
Yeah.
We just end up, like we don't compete on that space.
Yeah.
And so a lot of our dollars will flow south and never come back.
Yeah.
And, it's funny because Donald Trump is talking about Canada taking advantage. I would say we've actually lost a lot of talent to the States.
Yeah.
Where we should have retained it and we would have had a more competitive market space in our market.
Without a doubt.
Yeah.
Especially looking at, those very high paying industries, doctors, people in the tech space as well.
And just to give you context, like, my wife's nurse, as you know.
Yeah.
She could get paid double what she makes here in the States.
Double.
Yeah. And same with me.
Wow.
Yeah. Like
Wow.
the reason I choose to stay in Canada is because I have family here.
Yeah.
And I have ties here.
Yeah.
And I'm not unhappy with what I do and what I make.
Yeah.
But that being said, the market does price us a lot higher in the States than it does here.
Yeah.
And so like, my wife has a really good friend that's a dentist.
Yeah.
And one of the big things that she faces is also the same thing is, look, I can go and make so much more money in the States and I have to pay less taxes.
Yeah.
The only reason she's staying around is because of family as well.
Right.
Because at the end of the day, like, Canada isn't offering enough to actually, like, so if you don't have those ties that are tying you back,
Yeah.
the States is where you're making a lot more money. Why would you stay in Canada and do well still
Yeah.
when you can thrive in the States?
Yeah.
So that's where we need to compete
Yeah.
on tax policy, on incentivization, on finding ways and to finance some of these guys that will help us retain capital within Canada.
Right. Yeah. No, absolutely. No, that's definitely very well said. I mean, it's an unfortunate situation. Hopefully, it'll kind of head in the right direction soon. But
I'm hopeful. I think, as unfortunate as this timing is for the tariffs and whatnot, what it has reawakened in Canadians is a sense of patriotism. And it's reignited the conversation around, the resources and the things that we have to offer to the globe. And we had trade barriers internally in Canada that result in so much trade being lost just because we're putting up barriers to ourselves. And I think that opportunity to now reshuffle that mindset and look at opportunity differently honestly, in the next 20 years will pay off.
Yeah.
But the problem is we're going to have to weather a storm,
Yeah.
right?
They're really going to have to lay that groundwork
It,
to really change that.
well, that and with the tariffs coming in, I mean, it is going to be hard on people. That's an expectation.
Yeah.
Like it's unfortunate. Like I think Alberta will actually probably fare one of the better provinces to fare this.
Yeah.
Again, we have a resource that is needed. And many people will look at it and say, well, you know what, they could get oil from somewhere else. Yes, they can. But at the same time, I mean, our oil is refined in their refineries and they're set up in a way where they need that heavy oil.
Yeah.
And we have that heavy oil, and not many states, like fracking doesn't result in the same type of oil, so they'll need to rejig their refinery. So we'll continue to have oil and gas with us.
Yeah.
As energy demand increases, I think our products will become just as competitive, if not more.
Yeah.
Next few years, we might see a little bit of a dip in oil prices, but I don't see that being a long-term trend.
Yeah.
But yeah, so it's interesting to see where we're at.
Yeah.
And I think there's opportunities for us to take advantage of that.
Yeah. No, 100%. I mean, coming back to the real estate space, because I mean, at the end of the day,
this is a real estate
podcast, but I mean, there's a lot of really good nuggets in there, and lots of stuff that kind of talks about the Canadian economy, how the lending space works, and
you know what, like, to make informed real estate decisions, you have to understand the economics behind our markets.
Absolutely.
Right? Housing need only arises if there's demand, and demand will only arise if there's opportunities for people to move into our markets.
Yeah.
Right? If we're just saying, hey, look, our markets are going to stay flat, like people aren't going to move in, then there's not going to be housing demand, which results in more limited opportunity for us to build. Like we might still need to build maintenance stock.
Yeah.
But the broader economy will play into real estate decision making.
Yeah. Yeah. Well, it's also kind of interesting too, because you look at all these other countries, in Asia more specifically, right?
Yep.
You've got China. They've overestimated, they've overshown the amount of citizens that they have by over 100 million people. Yep. You've got Japan, their population's declining. You've got Korea, their population's actually stagnant. Whereas here in Canada, and also in the States as well, we're continuing to see growth year over year. So from that perspective, I think it's also going to be a very interesting shift and kind of how the world works.
100%. I think Canada is still a desirable place to live. I know that there's some headlines that would say otherwise. But I think Canada is still a desirable place to live. I mean, I live here. That's one reason you should move to Canada.
I think that's the best reason.
No, but what I would say is actually people will move to where there's opportunity, stability, and safety.
Yeah.
And I think Canada's done a good job of having the safety and stability piece. The opportunity side was good maybe a decade ago. But I think we can get back there. Because again, a lot of the resources that we have are under our feet.
Yeah.
The ground that we live on is just really well supplied with resource.
Yeah.
And so I don't see us, struggling as much as some of the other markets that, are more labor intensive. China has been more traditionally, because of the population size, has always been more labor intensive. And so you were like, especially I think maybe a few decades ago, you were able to pay less wages in those markets.
Right.
And so when, like, from a child of an immigrant's perspective, when there's opportunity to make money and there's a stable country and that you're safe there, you're going to try and explore that, right? Especially if your market isn't valuing you. And so I think that's why Canada and America have benefited from global population trends, is that we're able to provide a safe, stable environment where people feel comfortable. Like we have freedom of speech. I'm not saying that freedom of speech is a new concept in the world or that other countries don't have it. But we have a lot of nature. We have a lot of things to offer population. Not all countries do.
Right.
and we're very open to the entrepreneur, generally speaking, globally. Like, there are still countries that will compete with us, but we're we're more open than most countries. I wouldn't say like, especially the States. I mean, Canada's, again, I think we've talked enough about what we need to do lately. Um, but I think that's what's really driving population growth in our market, is that we're viewed as a safe place to be.
Right.
And safety, I think, honestly, I wouldn't want to live in a market where I didn't feel safe. Like,
No.
why would you want to live in a place, even if you could make a ton more money?
Yeah.
Like, at the end of the day, your life is more precious than any amount of money you can make. And
Yeah.
if you're unsafe in that market,
Yeah.
you're unsafe in that market. So I
Mm-hmm.
think what you're seeing from our population growth is that people are fleeing to safety,
Yeah.
and they're fleeing to economic opportunity. And
Right.
so even though for us, Canadians are struggling on the affordability aspect, uh, you know, but from a foreign perspective, like, I can speak to the Indian perspective, having come from an immigrant family from India. Um, you know, your dollar converts to 63 rupees in India, right?
Wow.
And although now, like, there are other factors that play into that, but the dollar used to stretch a lot further,
Yeah.
right? And so there was this like, your time and effort was rewarded with economic opportunity.
Yeah.
And so that's why Canada was so desirable, and I would still say for certain markets still continues to be so desirable.
Yeah.
Um, there's a reason why, and I would extend this to the Western world in general.
Yeah.
But there's a reason why we're facing a migration crisis.
Yeah.
People want to leave those markets that they feel unsafe in.
Yeah.
And there's a reason why people are willing to, like, come to countries that aren't super even welcoming of them anymore,
Mm.
but they're still trying.
Mm.
Or they're willing to cross over the Mediterranean
Mm.
to try and get into Europe, for
Mm.
example,
Mm.
because it's a flight to safety.
Yeah.
I think there's there's really a demand for being in safe, stable markets, and so I think that's why we're faring better on the immigration front.
Mm.
But just because we're faring better doesn't mean we don't have things to fix internally.
100%. And I mean, that's the other thing that I will say about Canada that is more of an advantage, I would say, compared to the States, is because of how the lending space is here, and just how the banks are. Like, although, you know, the barrier to entry is pretty high, the volatility is much lower. And because of that, it's a much safer investing in a Canadian market versus like the States, for example, right?
Yeah, I mean, to a degree. I mean, what that is coming at the cost of is that we're not funding enough innovation,
Right.
right? Like, we're not taking enough risk.
Yeah.
I think there's an optimal point of risk that we could take.
Yeah.
We got to figure out where that is for us.
Yeah.
But, like, the cost that we're paying is that yes, we're able to provide stable, consistent returns for companies.
Yeah.
But the cost that it's coming at is that we're stifling innovation, we're stifling future growth.
Right.
We need to, like, any good VC, and you talk to quite a few of those, is that they understand that not every company is going to explode.
Yeah.
But they want to get exposure to enough of them and to the ones that'll explode enough that it makes up for the ones that didn't.
Yeah.
And so
It's like buying a
yeah, you're buying a
dump
bundle.
truck of lottery tickets and
Yeah, and you're going to win some.
Yeah.
In like, I mean, I would say that with venture capital, for a good venture capitalist, it's more like digging for gold, but like, you're able to kind of use a metal detector,
Right.
right?
Yeah.
And so you're gonna get some silver, and you're gonna get some bronze, and you're gonna get some metal that's just scrap metal.
Yeah.
Probably a lot more of the scrap metal than you'll find gold. But when you do find gold, it's big enough that it makes up for all the other stuff that you found.
And then some.
Exactly.
Yeah.
Right. And venture capital, I don't think it's an activity where, and then there are still predatory players in the space,
Yeah.
but I don't think it's an activity that's just done for pure profit seeking, right? I would say that if you're going to be a venture capitalist, you got to have the guts to do it. Like you can't be so risk averse. It takes guts.
Yeah.
A lot of this stuff won't pan out, but also you kind of got to be intrinsically motivated to try and help another entrepreneur.
Yeah.
Right? Because a lot of these venture capitalists, they've made it. They've already gotten what they like. A lot of these venture capitalists are born from having done their own company.
Yeah. Yeah.
And built up other things.
Yeah. Yeah. Yeah.
So for them, like they're good. They can go retire. They can live off the yield if they needed to. I mean, some of them are motivated to try and make more, and that's a function of how much they want.
Yeah.
But others are actually just motivated by the ability to help create and be a part of innovation.
Right.
And so that's, in my opinion, that's kind of where the venture capitalist, like if you're a good venture capitalist, you're looking at it from a societal impact viewpoint.
Right.
Does it actually add value to
Yeah.
society
Yeah.
as a product?
Yeah.
And do I want to put my dollars behind this product to try and see if it'll work out?
Right.
If I was a venture capitalist, that's the way I'd be looking at it.
100%.
Yeah.
Yeah. Oh, that's awesome. Okay, coming back to the real estate side of things
Yeah.
again,
Because we keep on wandering off to different parts of the capital stack.
no, I think it's beautiful. I mean, ultimately, right? Like it's
Well, I'm a capital guy, right? Like I look at real estate all day.
Yeah.
But I also look at other stuff all day.
yeah.
And so I'm just trying to find a happy medium in terms of speaking. Again, a lot of the stuff that we're talking about, although it does not directly correspond with real estate, influences real estate markets.
Yeah. 100%. Yeah. No, I don't disagree at all. I think that, everything like talking about economy, talking about, safety of investment and all this other kind of stuff, that's really giving that full picture of what it looks like when it comes to the real estate side of things and an investment, and especially someone that's coming in from a different market potentially that does want to invest here in Canada. It's good for them to have that information because that's such geographical specific knowledge that people from outside of Canada wouldn't necessarily have access to, and even from province to province it varies so much.
And so like just kind of alluding back to one of the points that you had brought up, because Canada is viewed as a safe market, we have the ability to attract capital.
Yeah.
We just have to do a better job of getting our businesses and our stories out there.
Yeah.
That's all.
100%. Yeah. So I guess a question that I sort of have for you here is celebrity side of things was a very interesting.
Because we've kind of brushed over that though.
We brushed over that a little bit, but we didn't really go too in depth on what that kind of looks like, right? Because I mean, ultimately at the end of the day, the larger the projects that you're doing, the more capital that's being deployed into those projects, the likelihood of that person being of high influence is greater.
Yep.
So like first and foremost, of the projects that you've currently worked on thus far, are you allowed to say what the largest project that you have worked on has been?
Internally within my firm, about $100 million.
100 million. Wow.
Yeah. In my career, $4.5 billion.
4.5 billion?
Yeah.
In one project.
Yes. Yeah.
That's
there was a project financing.
Are you allowed to like mention any details on that one?
It was an oil and gas transaction.
Okay.
That's kind of all
makes sense.
That
makes sense. Oil and gas, yeah. No, for sure. So when it comes to like these more influential people that you're sort of working with, like what kind of confidentiality do you have to have when approaching these?
Yeah. So I can talk about the general like life cycle of a transaction.
Yeah.
So, because I'm working with such a sensitive amount of information, people are kind of laying bare what their finances look like.
Yeah.
To a degree. Not always do I get full disclosure. But generally speaking, they will give us enough to be able to understand their financial situation.
Right.
So there's a level of discretion that we have to apply to that because we're building trust. And so, deals can take 2-3 years in the making for us to just generate that level of trust with a client where they understand that we're not going to share anything without their consent, and that we have that level of trust with them to be able to advise them on how to best structure their financing and best capture yield and de-risk themselves and whatnot. It takes time, right?
That's a really long cycle, 2 to 3 years.
For some of the larger, like
Yeah.
more
Well, the
sophisticated.
$4.5 billion,
Yeah,
that one probably took a little while.
yeah. So to be fair to that one, like I was an internal to the credit team. So the way that banking is structured is that you have the relationship management side,
Yeah.
and then you have a second and third pair of eyes for some of those larger transactions. Look at it.
Yeah.
And so that wasn't a relationship that I originated.
Yeah.
But I was one of the folks that had the opportunity to work on the file and say, yep, that makes sense. This is a project that's viable for our bank to lend on.
Wow.
And so it was actually the knowledge and the acumen side was what was more deployed in that area for me than the actual relationship management side.
Right.
For this particular borrower, I would say, they've probably had a decades long, if not longer, relationship with us
Wow.
as the bank.
Wow.
And so, like, banks are afforded more credit than I as a broker am, right?
Yeah.
Because banks, hey, look, we got this big brand name behind us. It's a recognizable brand and people appreciate that. Whereas what I do now is much more nuanced. It's, a lot of times, you're getting exposure to me through, somebody that you might know, or, it's kind of like, we've met at an industry event kind of thing. So it's a very brand new relationship. It's not this 20-year history that I'm relying on with the lender. It's, hey, this is me. This is who you're going to work with. I'm your deal team. And I'm going to structure it in a way where, we make sure that you get what you're looking for, but also that the lender feels like the risks are mitigated and they're secured against something that's tangible that they can, work with as well. So deals do take longer from a broker perspective than they do from a bank perspective.
Yeah.
Banks, you get clients walk in the door, they'll say, okay, look, I recognize your bank. I've banked here personally for this long.
Yeah.
And so I'm comfortable coming to you.
Right.
Whereas as a broker, you're building up credibility for yourself.
Yeah.
So yes, discretion's key
Yeah.
in that sphere of influence. The other piece I would say is that, like, not all clients are waiting 2 years to send me a transaction.
Right.
Some clients you click with right away, I get a deal within 2 weeks. Right.
Wow.
Like it depends on the client and it depends on how far into the life cycle they are. Right. Like,
Yeah.
so I got some developers that I'm working with right now that want to do larger projects, but they now need to source the land. Then they need to go and rezone the land to whatever use they want to use it as.
Yeah.
Then they need to go get the permits. That's where I can help on the front end if they need land financing.
Yeah.
But I mean, unless you really need it, I don't recommend getting it because it's expensive, especially when your land's not shovel ready. Right. Like
right.
it's much more difficult to find lenders that'll do that too.
Yeah.
So I get engaged I can get engaged super early.
Yeah.
To be like, hey, look, and then I get to see how the project's progressing, and at some point I'll be able to add value to that project.
Yeah.
Right.
Yeah. No, that's super interesting.
Yeah.
So, like, with that in mind and kind of what we're talking about, I mean, it's interesting. One guy I talked to actually when I was on the island,
Yep.
they actually developed this RV park which had over 100 units.
Yep.
And when they developed it, originally it was just First Nations land.
Yep.
Instead of, going to some place to like purchase land or whatever, they were able to go to the band, say, hey, look, this is what our plan is. We would like to develop this land. It will be a cash flow opportunity for you guys.
Yep.
We're going to be setting all of this up. And over time, eventually that worked out in their favor for multiple different reasons. Like, number one reason for them is because they were able to not have to start to pay until they were at a certain point where they were able to start to realize income.
Yep.
And so that for that, their risk is gone down significantly, but they're also providing an opportunity that wouldn't have been there otherwise.
Yep.
So I guess kind of what my question is here is like, what are some of the more innovative financing structures you've seen in today's real estate market?
Yeah, I mean, it really depends. Like what you're talking about is a JV, right?
Yeah.
So, like, yeah, I've seen JVs happen all the time. Like, where a developer will get involved with a landowner.
Could you just for a second say what a JV is?
A joint venture.
There you go. Okay.
Yeah. So
Joint
basically, both the developer and the landowner share in this venture, and so they both own equity.
Yeah.
And so they're partnering up to build something amazing. Right?
Yeah.
And so the developer will want to, capture yield.
Yeah.
But it actually helps them de-risk themselves if there's, the landowner wants to work with them, because the landowner can continue to hold the land.
Right.
And they're not outlaying a whole bunch of cash right out the get-go.
Yeah.
And so because of that, developers prefer to JV, right?
Yeah.
Because they can capture yield without taking as much risk.
Yeah.
And at the same time, the landowner can benefit from the expertise of that developer.
Yeah.
To try and plan around their land and end up with, again, a product that they probably wouldn't be able to deliver on their own to the market.
Yeah.
And so there's tons of opportunities like that, I think, that we do see. Other, creative financing, like I talked about, kind of trying to bring in more corporate finance topics into the commercial real estate space. So I think there's going to be no new investment opportunities in that space just because of the level of competition that we're starting to face.
Yeah.
And so I think our capital markets will deploy capital efficiently in that space. What else do I see? Yeah, I think there's a lot of partnerships. There's a lot of second mortgages, mezz debt, etc. Like there's a lot of honestly, the best part about a deal is you can structure it how you want to, right? Like if you're
Right.
the deal maker,
Yeah.
if you got something to offer,
Yeah.
you can go offer it.
Yeah.
Now it's the counterparty's decision whether they want to accept your offer or not.
Right.
Right.
Yeah.
So like you can structure where, like, I've seen glamping operations. I've seen cannabis warehousing being converted into strawberry warehousing and manufacturing.
You would think it would go the other way, but I guess.
Well, cannabis over the years has experienced a lot of oversupply.
Yeah. No. Definitely. Yeah.
So the manufacturers, there's been a bunch that have gone under.
Yeah.
And so what do you do with those spaces, especially with the specialized equipment required to grow plants in a warehouse?
Strawberries.
Exactly. Like you grow other things in a warehouse.
Yeah.
Right. So I think like there's been opportunities there.
Yeah.
For us to kind of explore different ways of doing things. So I think people are very creative.
Yeah.
I think there will always be opportunity.
Yeah.
As long as you're willing to see it. I mean, I'm also a big fan of The Alchemist, if you've read The Alchemist. I think it's Paulo Coelho. I don't know how to pronounce his name.
Is that the one where they're talking about, because obviously alchemy, at the end of the day, it's turning something else into gold, but instead of the concept in this one, if it's the same book,
Yep.
Is you just change the perception of the other item.
No, so that's not it.
So what book is that? Do you know which one I'm talking about?
No.
Okay.
I haven't come across it. Yeah.
Okay.
Yeah. So like The Alchemist is it's a novel, like a fiction novel about a shepherd.
Okay.
That's exploring. I think it's somewhere in Spain.
Okay.
That's where it's set. And it talks about following and chasing dreams.
Yeah.
And that when people like society puts so much pressure on us to do certain things, like for example, in The Alchemist, the main character is a shepherd,
right?
Who was actually being trained to be a priest when he was younger, and that was a better career financially for him.
Yeah.
But he wanted to travel, and so he decided to become a shepherd.
Yeah.
To chase his dream of traveling.
Wow.
And so it talks about how people give up on their dreams and also how people chase their dreams.
Right.
And so I really found that amazing. And it's just because there's a lot of opportunity for us to pursue things, and we kind of look at it and say, look, society's going to value this or that.
Right.
Why does it matter what society values if you're happy with what you're doing?
True.
Why can't you be a shepherd, right?
Yeah.
If you want to travel, that's the way you travel.
Yeah.
There's no better time than now. Like, there's a good, and this will tie into our real estate conversation, but there's a good saying in real estate, which is, the best time to buy was yesterday.
Yeah.
The next best time is today.
Yeah.
And so I think we kind of got to start living our lives like that a little bit more too.
Yeah.
Is the best opportunity is right now.
Yeah.
For us to make whatever we want to make with our lives.
100%.
Right.
Yeah.
And so, like, that's kind of what I'm seeing in my world is like, lending, especially being at the commercial banks, very stable job. It pays well. But it wasn't giving me the sense of purpose that being a broker does, right? Like, because you're engaging earlier, you're having more meaningful, more direct, honest conversations, and you're figuring out ways to creatively structure their transactions.
Yeah.
And that's kind of what drives my purpose is like, I like puzzles.
Yeah.
Right? Like, I like trying to solve a problem and say, okay, look, what if we change this? What if we treat that?
Yeah.
And I like seeing strategy being implemented because business always ends up at, it's a process and it's people.
Yeah.
Right?
Yeah.
And if you got good people, really, you just got to tune your processes and you should be able to make that business more successful. And now, certain products, they're just never going to work out.
Yeah.
But most products, you can tweak your process or your people, especially in established markets, to get results.
I think in general, that's a super interesting, point of view. And, we've talked about it before where like, not just puzzles, but you also like strategy and this kind of thing. And it's just interesting to kind of think about ways that you can actually impact a market in a very large way.
Yep.
And so, I think that's great. So coming back to the real estate side, coming back to the development side, how do you assess the risk profile of a development project when deciding whether to offer funding?
Yeah. So what are lenders looking for?
Yeah.
So I think like for real estate in specific, they want to work with people that have done it before.
Yeah.
Right. Like, if this is your first project, not to say that you can't get funded, you still can.
Yeah.
But it's a lot easier if you've done this project 10 times,
Right.
20 times, 100 times, right? Like,
Yeah.
larger capital is always going to want to deploy with people
that know what they're doing.
That know what they're doing and that are experienced in it.
Yeah.
So that's one big key consideration. The other key consideration is, how does your financials look based on the project?
Right.
What does your budget look like?
Yeah.
Is it reasonable? And that also plays a role.
Yeah.
Lenders, especially, again, bigger lenders, want to deploy capital with people that don't actually need the capital sometimes. Right? Like, if you got $100 million net worth and you're doing a $10 million project, it's a lot easier to get capital than it is for you to be worth $1 million and try to do a $10 million project.
Right. The reach is just different.
Exactly.
Yeah.
It's a different scale, and so there's a different level of trust afforded to that. So I think that's one big key. And having good liquidity is another piece that of that puzzle. I mean, there's no magic number for liquidity, but having access to capital always improves the outcome.
Right.
Just, again, something goes sideways, you have the ability to inject a little bit more to kind of save your deal or save the lender.
Yeah.
I think lenders appreciate that opportunity.
Yeah.
Then it's like I said earlier, it's the financial metrics of the deal itself. Like, which market is it in?
Yeah.
How big of a population is it? It's very different to be building in Calgary, which has, I think over 1.6 million people in the general vicinity.
Yeah.
Than it is to be building in something like Innisfail or in Rimbey or like some of the smaller towns. Just because your product is much more material in terms of how much of the market that you're going to supply with it.
Right.
So that's the key.
Yeah.
component to it, right? Like
Yeah.
understanding that. And so there's a lot less capital available to more rural development, which I think that there's a necessary need for that.
Yeah.
But I think lenders just want to, again, they're looking, lenders always look at worst case scenario.
Yeah.
Right? Because
Yeah.
no, because they're not getting any of the upside, right? Like they're only
Yeah.
getting a fixed rate of return
Yeah,
on their capital.
Yeah.
So they will want to fund the least risky deal
Yeah.
that yields the most money to them,
Yeah.
like anybody else.
Yeah. Yeah. Yeah.
And so I think that, like, where do you, like, so what we're really getting to the root of is where is risk
Yeah.
within a deal.
Yeah.
So it's management, it's market,
Right.
it's your construction products and your construction. Like if you look at a product, like a project financing structure, not just real estate, just generally any product
Yeah.
that you're looking at. If you're financing a project, you want to make sure that you have your offtake. You want to make sure that you have your feedstock.
Yeah.
You want to make sure that it's insured properly. You want to make sure that the operators are experienced in both constructing and in operating the facility.
Right.
You want to make sure that you're covering, you're not over leveraging yourself, or you're not overly promising high returns for the investor. So there's a lot of areas where you can look at risk, but the basic foundation is going to be, you want to lend money to people that you trust.
Yeah.
You want to lend to markets that are a little bit more established because it's just more liquid.
Right.
If there's something that goes sideways,
Yeah. Yeah.
more investors will buy a distressed property in Calgary than they will in Sundre.
Right.
So, and then you want to make sure that the market that you're building in isn't facing headwinds as well, right? Like, for example, in Calgary, we might actually see a little bit of a rental drop. And
even coming into our peak season?
I would say so, because we have been supplying the market really quickly, and there's still money to be made in supplying the market. But yes, I do think that we have seen in the last few months a tapering off of rents and maybe even a slight dip. That doesn't mean it will have to continue, but yeah, like you want to be building in markets that are more like Calgary, less like Toronto or Vancouver. Right. Because those are the markets that you're really struggling with filling up now. So in capital, like the way that capital works is it's going to try to find the least risky and most convenient way to pull it. Like anybody who has capital wants to deploy their capital in liquid, high yield, and low risk environments.
Right. And
so, creating those environments is part of it. Is there's systematic risk. Everybody in Alberta every developer in Alberta faces the same risk of, rental lease up, or in terms of sales. Like if the market's going up, the market's going up. If the market's going down, the market's going down, and if it's flat, it's flat. That's not something that you can control. But what investors and I would say lenders want to look for is, how does your operation fare against others, and why should we put our capital behind you versus somebody else? Right? Like that's the business case that you have to build out, is why do we deploy capital behind you? And sometimes it's not always about experience. Maybe it's an ambitious project where there's just so much risk mitigation in place that it can work. Or other times, sometimes somebody's ambitious and they want to still get involved in the industry. Great way to do that, partner.
With someone that already has that.
Exactly. That has that background, that resume of being able to deliver projects on time, on budget, and have those projects work out. And then once you get a few under your belt and you've gotten the exposure to be able to go and do it yourself, that's where you get involved. And that's where actually I should speak to your platform, because people that want to invest in these projects, not always do they have the time to actually go out and build this stuff. And so creating an opportunity and a platform for people to get together, and the capital providers can meet some of the experienced developers
Yeah.
is a great platform to be on,
Yeah.
right? Because
Yeah.
you can capture yield as an investor,
Yeah.
and as a developer, you can capture opportunity,
Yeah.
and that's where money's going to be made.
Yeah. No, absolutely. And with that too, I mean, with the platform as well, I appreciate you bringing it up. You know, um, part of it as well is in de-risking those projects just by looking at data points on how those companies have performed in the past. So at the end of the day, a lot of stuff can be faked, and unless you have that personal relationship with somebody, it's hard to really understand where that person's coming from. And especially if you are someone that is a new real estate investor or something like that, you don't necessarily have those strong relationships with a lot of people in the industry, or but you have the money and you want to deploy it into real estate. Being able to have access to those people and knowing pretty easily what this developer or this builder, this construction company kind of looks like, I think is a very, very helpful thing. So with that though, I'm very curious, like what role does a developer's track record play in securing financing, and are new developers at a bit of a disadvantage?
Yes, I mean, it's a lot easier for an experienced developer to get access to capital from their track record
Yeah.
than it is for a new developer to come into the space. I mean, that's just like, one's a proven, deliverer of a project, the other isn't yet.
Yeah.
So naturally, lenders are going to gravitate when it's just those two opportunities and they can only deploy capital into one of them.
Yeah.
They're going to levitate towards the one that has better experience, all else equal.
Yeah.
But there's ways to make up for that. One is, again, partnering with a good equity source,
Okay.
so that it de-risks the project from that perspective. Again, from an event of default perspective, if you have assets behind you, it's a lot easier for a lender to be like, okay, you don't have the experience, but you have capital.
Yeah.
And that'll afford you some credit.
Yeah.
And make up for it. So there's other factors that'll play into it.
Right.
Having more liquidity.
Yeah.
Again, maybe you haven't done this project, but you know people that have.
Yeah.
And so you can help, you can maybe look at bringing them on as partners or as advisors.
Yeah.
To help de-risk the project from a banking perspective. There's a variety of ways you can try and mitigate around it.
Yeah.
But if you're just asking in a vacuum, that's the only factor. Hands down, you're probably going to see almost all the lenders bet on the guy that's done it.
Yeah. Yeah. No, that's I mean, it makes sense at the end of the day, right? You want the guy that's done it every time.
Yeah,
but it doesn't always necessarily mean that person is going to do the best job. It just means that they have that track record of doing good enough.
Yeah, so it's like if you had the opportunity to work with, I don't know, like Ovechkin,
yeah,
on your team, or some new guy from Russia. Not to say that new guy potentially couldn't be better than Ovechkin. I mean, over time, we probably could develop to that level.
Yeah.
But you're not going to bet on somebody,
yeah,
that hasn't shown that they can perform at that level.
Yeah.
Right? Capital wants to bet on people that they know will deliver.
Yeah.
And even if that means that you have a lot of potential, they would rather deploy their capital with somebody that has less potential but is a more measured quantity.
Right.
I've been fortunate in my career that I've been able to experience different areas of finance.
Yeah.
Most people in my industry stick to one.
Yeah.
Right? Like a real estate lender will be a real estate lender for their full career.
Yeah. Because it's just safer that way.
100%. A corporate banker or a commercial banker will always want to be in that space that they understand.
Yeah.
I've kind of tried to go against the grain on that.
Yeah.
Where I've tried to go and get more experience.
Yeah.
In different things that hasn't necessarily always panned out in terms of comp.
Yeah.
I've always recognized that there's opportunity to stick in my field, in my lane.
Yeah.
And make more comp for doing that.
Yeah.
But for me, like I said, one of the funnest parts of my job is getting in front of people that, do different things.
Yeah.
because I don't want to do the same vanilla deal every single time.
Yeah, yeah,
Like
yeah.
I love the opportunity to work with entrepreneurs, and I think there's a lot of different things that we can do to add value to that.
100%.
Yeah.
One other thing I do want to say about, kind of what you said as well is, you know, um, though you have gone into a couple of different spaces, but still in that lending space, it has all kind of been around a very similar
Yep.
kind of industry. So it's not like you're like jumping around from like, single family to then going to commercial and whatever.
Yep.
But it's, because of it, you're able to have such a more broad perspective, broader understanding. You're able to offer people, you know, a lot more help and actually give them a much better setup than they would be able to get with someone else that's only been in that one specific industry for however many years.
Yeah. So being around this industry for a while, and having done different roles within this space, has afforded me the opportunity to kind of look at things from a more broad scope, like you said.
Yeah.
It's also like given me perspective on what really is risk.
Yeah.
And so, like in banking and in lending, equity, etc.,
Yeah.
all you're trying to do is quantify risk.
Yeah.
And when you can quantify it, you can figure out what you should charge for taking on that risk, or whether that risk is even worth you taking on.
Right.
And so I've been fortunate to be exposed to the lending landscape because it influences so much of the capital stack. In real estate now, like for a multifamily developer, it's 95% of your capital stack.
Wow.
It drives your deal.
Yeah.
Whereas for commercial, it's a little less, opportunistic. Some of those deals you might see 30, 40%, 50%, depending on the risk.
Yeah.
But it's still a substantial portion of your capital stack. And
Yeah.
so you're still looking at it. You're not layering the equity side onto it.
Yeah.
You're looking at it and saying, okay, I'm going to get a 7% return on this or an 8% return on this from a banking perspective.
Yeah.
But you still need to look at the same downside risk as an equity investor will.
Yeah.
You just don't look at the upside and say, okay, there's potential here to make more money.
Yeah.
So it's kind of like debt is a much larger industry than equity is.
Yeah.
And so getting exposure to the debt side, it's kind of like layering on the equity. It's an additional fact. It's like I was talking to a lawyer where, if you're a good real estate lawyer, or if you're a good commercial lawyer, you layer on another piece would be like securities law. You need to understand all the commercial side behind it.
Yeah.
And then you can layer on, this is how securities work on top of it.
Right.
So you're building on that knowledge.
Yeah.
So what I've had the fortunate pleasure of doing is I've gotten a good scope in terms of the debt side.
Yeah.
And because now I kind of work on both, it's layering on that upside and saying, switching my hat on and saying, look, this is where we can make money, we can garner returns. And so for me, the theme of this year is getting in front of more family offices, more investors.
Right.
To actually go and present and say, look, we have opportunity here.
Yeah.
Let's seize it.
Yeah.
Let's build out more opportunity for everybody to make money.
Yeah.
And look at it from a framework of, de-risking ourselves, making sure that regardless of how the deal is structured, you're whole.
Yeah.
And you're making money off of it. Right.
Okay.
Because your goal is to, like any investor's goal, whether you're investing in the stock market, you're investing in real estate, investing in alternative investments, your goal is going to be fairly similar when it comes to the capital side. It's to preserve.
Yeah.
It's to grow.
Yeah.
And it's to, just have your money make more money. And the best way to do that is to de-risk yourself and add where you can.
So when you're approaching these family offices, what is it exactly that you're doing when you're talking to them?
Well, I'm learning about what they want to see.
Yeah.
Like from an equity perspective or a debt perspective.
Yeah.
Some, depends on their appetite.
Are you like raising capital from them or?
Not yes and no. I mean, I'm not raising a fund.
Okay.
But yes, let's say I have a opportunity where they do need equity,
Hmm.
I can go and say, hey, look, family office, this is a business that aligns with which space you want to be in.
Yeah.
Why don't you supplement their debt side with some equity,
Oh,
right?
okay.
Because like family offices, they're born out of success in business,
Yeah.
and so they understand the industry that they've been in.
So
And
they're kind of almost like a VC in a way.
yes, like they're writing checks as well.
Yeah.
Sometimes they'll want some more control. Like it's, I guess, yes, you could say that they're just looking for more stable business. That's all,
I see.
right? Like they're not necessarily investing in high growth, high return businesses. They want consistent capital, and they can be more like forgiving if your yield's not as high, but you're safer,
I see. I
right?
see. So they've made it big, and now they're just trying to keep their money
Yeah, they're
continuing
trying to
to.
invest into like other opportunities outside of just the stock market, because the stock market's one way of investing.
Yeah.
Um, I think that the private markets do have more lucrative opportunity.
Right.
It's like, and again, I'm going to bring up Warren Buffett, but he had more opportunity when he was younger.
Yeah.
Not because of his age, but because the the capital that he was playing with, he could, go into smaller companies
Yeah.
and help like understand them and help them grow to a big scale.
Oh.
Now, when he has billions of dollars, he can't put billions of dollars in a company that needs 1 million,
Right.
right? Like,
Yeah.
so he has to find bigger companies to invest in,
Right.
and so he's kind of handcuffed,
Yeah.
in terms of where he can invest his capital.
I see.
Whereas smaller investors are able to be more nimble,
Yeah.
right? Because like $1 million deal is meaningful for their book.
Yeah.
$1 million deal in Warren Buffett's book doesn't even move the needle on how much capital he has to deploy.
Wow.
Right? And it's trying to figure out how do you efficiently deploy capital.
Yeah.
So yeah, like I think family offices and this alternative investment space will grow,
Mm-hmm.
because there's a lot more yield to be captured out of it.
Right. That's super interesting. And so one thing about this podcast and that I want to do for everybody that kind of comes in is if there is something specifically that you're working on right now and you need some assistance in some way, or maybe you need some kind of help, or you want more family offices to come in and work with you, something like that, I'm kind of putting it out there so that if there is someone out there that does need help from you as well, they're able to reach out and kind of chat with you with what you're doing right now. I do know that you kind of mentioned that you've captured a specific piece of the market where you see a gap and you're able to kind of go after it because those big players are too big and it's not really worth their time necessarily. So with what you're doing right now, is there something that you could you would like where you would like to take your expertise and how you would like to service?
Yeah. So I can speak to two facts.
Yeah.
Right? Being in sales, I love doing sales. So if there's an opportunity to work with somebody that has an interesting project, um, I wouldn't mind taking a peek at it to see if there's any value I can add. And as you know, sometimes I'll just say, hey, look, I can't add value.
Yeah.
Right? Like you got the
Which
project.
is a super big deal when it comes to this kind of industry. The fact that you actually push customers away because you care more about them versus the deal itself.
Well, that's the goal, is to provide value.
Yeah.
Right. And so for me, what I define that as is like, if I'm not bringing something to the table, I shouldn't be involved yet.
Yeah.
And like, I hope that by doing that, I'm creating that relationship.
Yeah.
With the client, to be like, look, get me involved when I can add value to you.
Yeah.
And I will.
Yeah.
If you get me involved in a phase where I can't do that,
Yeah.
then like, why am I here? Like, you can figure it out.
Yeah.
So anyways, back to kind of your original question. I think, so one is just, opportunities. I wouldn't mind looking at more.
Yep.
As although I've been in the industry for a while, I'm kind of fairly new at this brokerage side, and I'm still trying to grow my book.
Yep.
So there's always opportunities from a client perspective.
Yep.
And then introductions to family offices.
Yep.
Like I would love to speak to more investors, to try and create more of an environment to work together.
Right.
And like the great thing is I've gotten a great amount of exposure to investors.
Yeah.
So I know the language that's needed to speak with them.
Yeah.
But also, like, there's always an opportunity to add value to them as well, right? Like, and to add value to myself.
Yeah.
And so if there's a mutual opportunity for us to work together,
Yeah.
or me to just come in and do a presentation,
Yeah.
doesn't hurt.
Yeah.
Yeah, I think that's kind of the two areas that I'm focusing in on right now for this year.
Yeah. Yeah.
Is just growth
Yeah.
and opportunity.
100%.
And then I think that's kind of been the theme of today too.
Yeah.
Right.
Yeah, it really has been now, kind of
Right.
looking back on all of it.
Yeah.
Yeah, yeah, yeah. Well, and speaking again to Nahr, I mean, it's obviously, you're not just some small guy that's only done, a couple $1 million in deals and whatever. It's like, some of the clients that you're actually working with are of that really, really, really high caliber. So even though you are newer to that brokerage space, doesn't mean that you're not educated or don't know what you're doing. It's actually quite the opposite. Is you've taken all of this experience that you've had in the past to really propel yourself way further past people that have even been a broker for say 10 years, right?
Yeah, I mean, the good thing is I've gotten the experience from just being a lender for a decade, and I've moved around a lot.
Yeah.
Which employers don't look at favorably, but my clients do.
Yeah,
because now I know those policies and I have relationships internally.
Yeah.
And then the other part is like I've always been interested in finance and real estate and economics. About a decade ago, I finished university with a double major in economics and finance.
Yeah.
So that crux has always just been very interesting to me.
Yeah.
And then I supplemented that with an MBA.
Yeah. Just supplemented.
Yeah. Focused on real estate development. That's given me the opportunity to look at opportunities differently.
Yeah.
I for most of my career I had a lender hat on.
Yeah.
And that hat is very adverse to risk.
Yeah.
Right? Like lenders don't want to take risk.
Yeah.
They don't want their name on a deal that's going to go sideways.
Yeah.
And not to say that I, as a broker, I want to put my name on a deal that goes sideways either, but it's understanding the equity perspective that has kind of made me more well-rounded.
Yeah.
And saying, look, this project only works if both those pieces, the lender and the equity, can get behind it. And that's kind of the goal for me, is to bridge those two.
Yeah.
To make sure that the investors, the developer, and the lender all align on the project well enough that there's opportunity created out of it.